Hi. For those of you I haven't had an opportunity to talk with before, I'm Jake Winegrad from Moneta. If you've looked at your 401k balance recently, you've probably noticed something. It's up, maybe significantly. And you might be wondering, should I do something? Let's take just a few minutes to talk about what's happened in the markets, what it means for your retirement account, and what, if anything, you should actually do about it. Over the past 3 years, US stocks have had an exceptional run. The S&P 500 gained more than 20% in 2023, 2024, and 2025. And as I talk to you today, it's up significantly, close to halfway through 2026. To put that in perspective, 2 consecutive years of returns exceeding 20% has only happened a handful of times in the history of the markets. That's great news for you if you've been invested, but also raises a fair question. What comes next? Here's something worth understanding about this rally. It hasn't been evenly distributed. The 8 largest companies in the S&P 500 now account for more than a third of the entire index, compared to about 15% a decade ago. A relatively small number of mega cap technology companies have driven the majority of the gains. That matters for your 401k, because if your portfolio has had exposure to large US growth stocks, you've benefited enormously. But you may also be more concentrated than you realize due to this run-up. So what should you actually do? A few things to consider. First, check your allocation. After a big equity run-up, your portfolio may have drifted from your target. If you set a 70-30 stock to bond mix a few years ago, you might be sitting at 80-20 or higher today. Rebalancing brings you back in line with your risk tolerance, not because markets are definitely going to go down, but because discipline matters. Second, don't try to time the market. The temptation after a strong run is to pull back and wait for a dip. Historically, that strategy tends to hurt more than it helps. Time in the market has consistently outperformed time out of the market. Third, keep contributing. If you're still working, keep your contributions going. Dollar cost averaging, putting in a consistent amount every paycheck, means you're buying more shares when prices dip and fewer when they're high. It's one of the most powerful tools available to you. And fourth, consider your timeline. If retirement's 20 plus years away, short-term market fluctuations matter far less. If you're within that window of 5 to 10 years from retirement, now's a great time to review your glide path and make sure your risk level matches where you actually are in life. A strong market is obviously a good thing for your retirement savings, but it's also a good reminder to stay intentional, to check in, stay diversified, and keep your eyes on the long game. If you have questions about your 401k or want to review your investment options, please feel free to reach out to us. We're here to help you make the most of what the market's given you and to help you protect it. Thanks for watching.